Welcome to the Deep Dive.
Great to be here.
So you've brought us a fascinating pile of material, articles, research notes, all centered on, well, a giant of finance, Carl Icahn.
Definitely a compelling figure.
Yeah.
Contentious, too, often.
Right. And our mission today is to really dig into that material, cut through the noise, and try to understand his investment operating system. How does he actually think? What makes him tick? What's the core method?
It's a system built over, decades now? Lots of battles, lots of returns. And these sources, they really give you a sense of the logic behind it, what drives that famous Icahn lift.
Exactly.
Yeah.
So we'll unpack his core beliefs, his investment philosophy, then walk through the specific filters he uses, the checklist, basically.
See how it holds up under pressure.
Yeah, with a big example, Netflix comes to mind. And then we'll stress test it a bit against the modern market.
And try to pull out the single biggest lesson you can take away from all this.
Sounds like a plan.
Yeah.
It's a journey through strategy, psychology, and sheer persistence, I think.
No doubt. Let's dive in.
Okay, so kicking off our deep dive into the Icahn system. We actually start in Queens, New York. Carl Celian Icahn, born in 1936. His path wasn't exactly typical Wall Street, was it?
No, not straight out of Wharton or anything. He starts with a philosophy degree from Princeton, which is, pretty interesting in itself.
Philosophy first. Then what?
A few zigzags. Tried medical school, brief stint in the army, then he finally lands on Wall Street in '61.
As a stockbroker initially.
Yep, stockbroker, then got into options trading. And by 1968, he forms Icahn & Co. The early focus was risk arbitrage and options.
Risk arbitrage. Remind us quickly.
Basically exploiting tiny price differences between related securities, often around mergers or takeovers, very analytical, looking for those small edges.
Got it. And that analytical side mixed with, let's say, a growing dose of aggression. That's what led to the corporate raider label in the 80s.
That's certainly how the public saw him then. It was definitely about aggressive tactics, hostile takeovers sometimes. That label sort of softened over time to activist investor.
But the core goal didn't really change.
Fundamentally, no. It's always been about finding companies he sees as undervalued or, frankly, badly managed, and then using whatever power he has to force change, to unlock value for the shareholders.
And his main vehicle for this now is Icahn Enterprises.
That's right, his big diversified holding company. And his method, like you said, it's not exactly subtle.
Taking big stakes in companies?
Substantial equity positions, yeah. Then it's public pressure campaigns, proxy fights, trying to get his people onto the board. Intense negotiations in the boardroom.
All aimed at shaking things up. Management strategy, how they spend money.
Exactly. He's agitating for fundamental shift.
Which brings us to the Icahn lift.
Yeah.
The stock jumps just because he showed up.
Right. And that lift, it's real. It's the market instantly saying, okay, Icah's here, something is going to happen. It's a belief built over decades that he will, fight tooth and nail to compel an outcome.
So, looking at all this material you've brought, the big question really is, beyond the headlines, the battles, the reputation.
Yeah.
What is the actual philosophy? What defines this system that's been so controversial, but also generated so much alpha for so long? Where's the genius? Maybe where's the vulnerability?
Well, what really comes through from these sources is that his edge isn't just finding undervalued assets. A lot of smart investors do that.
It's more than stock picking.
Much more. It's his conviction, his willingness, and maybe his unique ability to force that value to be realized, to make it happen.
He sort of weaponizes the inefficiency he finds.
That's a good way to put it. He's basically arbitraging managerial complacency, market irrationality. It's all fueled by this deep belief in shareholder rights, shareholder supremacy almost, and a huge skepticism of entrenched corporate power.
He doesn't wait for the market to figure it out.
No, his whole system is designed to compel change, to turn that passive hidden value into actual realized profit.
Okay, that idea of forcing change is key. But how does that belief system translate into, practical steps? What's the underlying logic? Which brings us to the foundational pillars, right? The core beliefs his whole approach rests on.
Right. You have to understand the worldview first, the lens he uses.
And central to that, based on these sources, is the idea that markets just aren't efficient. They're often irrational.
Absolutely fundamental. He just doesn't buy the efficient market hypothesis, especially for neglected or misunderstood companies. There's that great quote you found. I buy assets and potential productivity. Wall Street buys earnings, so they miss a lot of things that I see.
So Wall Street's too focused on the short term.
That's his view. They miss the underlying value, the gold, as he might put it, hidden in the assets or the potential. Yeah. And that justifies his contrarian approach, right? Going into companies nobody wants.
Makes sense. If markets get it wrong, there's opportunity. But the second pillar feels even more core to the activist part. His view on management. Often self-serving, inept, maybe just stuck.
This is probably his most critical belief, the one he talks about most publicly. He sees CEOs getting paid huge sums without delivering for shareholders. He talks about crony board members protecting the status quo.
It sounds like the classic principal-agent problem.
Exactly. It's straight out of Burl and Means from, 1932? The theory that when ownership is separated from control, the managers, the agents, tend to look out for number one, not necessarily the owners, the principals.
And he sees that everywhere.
He sees it everywhere, and his activism is positioned as the solution. His famous Icahn manifesto back in the 80s was basically his playbook for fixing this. He literally wrote that sizable profits can be earned by taking large positions and then attempting to control the destinies of the companies.
Wow. So the justification for being aggressive is built right in. He's correcting a flaw.
That's how he frames it. Intervention isn't just about profit. It's almost a moral imperative for him. He sees activism as this vital corrective force, making companies better, more competitive.
He has that quote, doesn't he? Something about fighting tyranny.
Yeah, a lot of people died fighting tyranny. The least I can do is vote against it. He knows it's hyperbole, but it shows the conviction. He's battling corporate complacency on behalf of the owners.
And this focus on undervalued assets creates a kind of safety net, doesn't it? Asymmetrical risk.
Yes, that's crucial for his downside protection. He's looking for companies trading way below net asset value or tangible breakup value. The idea is, even if things go sideways, the hard assets provide a cushion.
So the potential upside from forcing change looks much bigger compared to the potential loss.
Exactly. Disproportionately large, ideally.
And underpinning all this is a fairly, maybe cynical view of human nature in big companies. Complacency, resisting change, self-preservation.
Unless confronted. His whole system kind of depends on these flaws being common. If everyone always acted perfectly in shareholder interests, his whole model wouldn't have much traction. His success is, in a way, proof to him that these dysfunctions are widespread and, exploitable.
Okay, so that's the worldview. Deeply skeptical, focused on assets and owner rights. But how does that turn into an investment decision? That's where the filters come in, these non-negotiable criteria.
Right, and these aren't just loose guidelines. They're pretty rigorous, like a checklist.
So what are the main ones? Let's stick through them.
First, significant undervaluation. We talked about this deep discount to tangible assets, breakup value, low PE, low price to book. The rationale is pure value investing. Buy stocks for a lower price than the net asset value.
But with a twist.
The twist is, he knows that value often needs a push. It won't just magically appear, which leads to the second filter.
Poor management or strategy. It can't just be cheap. Something has to be wrong with how it's run.
Exactly. Clear, identifiable failings. Bad capital allocation, weak strategy, maybe excessive CEO pay as a signal. The justification is straightforward. Current management is not able to maximize the asset's value. So intervention is warranted.
Makes sense. Then, critically, you need identifiable activist livers. You need a way in.
Right. Can he actually exert influence? Is there a clear path to get a big enough stake? Can he realistically push for board seats? Are there specific actions, selling a division, spinning something off, forcing a sale, that are plausible?
Things he outlined in that manifesto?
The tactics, yeah. Proxy contests, tender offers, convincing management directly. He needs actionable targets where his playbook can actually work.
And the last filter ties it all together.
Yeah.
A pathway to unlock value.
He needs to have a plan, something credible he can articulate that management isn't doing. He has to believe he can convince others, the board, other shareholders, that there's hidden value here, and his plan will unlock it. This is what creates the catalyst for that Icahn lift.
You can really see how they interlock. The undervaluation often comes from the bad management, and the levers are what let him force the fix, the catalyst.
Precisely. It defines his hunting ground. And it also explains why he avoids certain areas, right? Like high-growth tech with few tangible assets, or companies where a founder has iron grip control. No levers there.
It's fascinating how this practical, often brutal operational style has these deep intellectual roots. That philosophy degree wasn't just a random detour.
Seems pretty core, actually. His thesis was on empiricism, this idea of separating gold from sand. You see that in how he digs through financials, looking past the obvious stuff.
How would that empiricism actually show up when he's looking at a company's books?
Well, instead of just glancing at the PE ratio, he'd be really tearing apart the balance sheet, looking for, say, hidden real estate value, or maybe a patent portfolio that the market isn't pricing correctly.
Stuff buried in the footnotes.
Exactly. Or maybe a subsidiary business that's being neglected but could be valuable if spun off. He's sifting through all the data, the sand, trying to find that verifiable, overlooked gold. It's a very fact-driven, almost forensic approach.
And then the direct link to corporate governance theory. The principal agent problem again.
Yeah, his manifesto is basically his applied solution to the problem Berlusconi's identified way back. They saw the issue. Icahn built a business around exploiting and, in his view, fixing it.
He weaponized academic theory.
Pretty much. Used it as ammunition to challenge CEOs, demand accountability, champion shareholder rights. It elevates his game beyond just being a raider. He's fighting for a principle, grounded in theory.
And basic economics underpins it too. Self-interest driving behavior.
Definitely. People, including managers, act in their self-interest. His moves are designed to realign that self-interest, make sure the CEO's goals line up with the shareholders' goals, maximizing value, optimizing resources.
So it's this blend. Empiricism for the analysis, finding the gold, governance theory for the justification, fixing the agency problem, and economics for understanding the motivations.
And that combination gives him incredible conviction. It allows him to withstand the attacks, the criticism, the long fights, because for him, it's not just about money. It's about proving his thesis right.
Okay, that lays out the system beautifully in theory. Worldview, filters, intellectual roots. But theory's one thing. How does this operating system actually handle the heat? When markets go crazy or the target company fights back hard, where does the rubber meet the road?
This is where Icahn's temperament becomes absolutely critical. It's not just a personality quirk. It feels like a core engineered part of the strategy.
Engineered for confrontation, you mean?
Absolutely. Given his core belief that management is often the problem, he goes in expecting a fight. He's famously not shy about criticizing leadership and pushing for change, even replacement.
So, public battles, proxy fights.
That's not a bug, it's a feature.
It has to be. Passivity would kill his model, which is all about forcing change. He needs that confrontational edge.
And it requires being a true contrarian.
Definitely. Buying assets nobody wants, going against the herd. His early experiences in market downturns probably taught him how crucial that is. It takes real psychological strength to bet against popular opinion.
Plus patience. These things don't happen overnight.
No way. Campaigns can drag on for years. You need serious staying power. He said it himself. Being an activist, you have to have staying power and patience.
But it's not just brute force, right? The sources call him a chess grandmaster. Calculated aggression. That's the key duality. He can be incredibly fiery in public, really scathing, but underlying that is usually very deep, cool-headed analysis. His temperament lets him pursue that empirical search for value relentlessly, no matter how uncomfortable it gets for the other side.
Okay, let's put the system to a real test. That iconic investment, Netflix.
Ah, yes, a fantastic case study. Shows the power and also, maybe, the limits. Remember the context. 2011, 2012, Netflix was radioactive after the whole Quipster fiasco.
Oh yeah, separating DVDs and streaming, hiking prices. Disaster.
Total PR nightmare.
Oh.
Customers furious, investors bailed. The stock absolutely cratered down like 80% from its peak. Management was under siege.
Sounds like a perfect Icahn target. Undervalued management missteps.
From his perspective, absolutely. His worldview saw a massive market overreaction. Netflix punished unfairly. Yes, management blew it with Quickster, but the underlying streaming trend, which apparently his son Brett really pushed him on, was incredibly strong. The market was missing the long game.
So how did his filters line up?
Undervaluation, check. He bought about 10% in late 2012 for around $321 million. Average price, something like $58 a share, pre-split, way down. Poor management strategy. Quickster was Exhibit A activist lever. A 10% stake gives you a loud voice. Initial thinking was maybe pushing for a sale, pathway to unlock value. Pressure management, maybe force that sale or at least demand governance changes.
And the intellectual lineage. Seeing the gold beneath the sand.
Empiricism pushes you past the Quickster noise to the real asset, the growing subscriber base, the platform, and the agency critique. Perfect fit for how management handled the crisis and torched shareholder value.
So Icahn shows up, Temperament engine firing. How did Netflix react?
Defensively. Put up a poison pill almost immediately to make a takeover harder, with a low 10% trigger. Icahn, predictably, went public, blasting it as poor corporate governance, attacking their board structure. Classic Icahn counterpunch.
And the outcome was, financially, a huge win for him.
Massive win. Sold about half his stake less than a year later for over $800 million profit. Got out completely by mid-2015. Total profit estimated around $1.9 to $2 billion. He nailed the undervaluation and the streaming potential.
But, and it's a big but, the miss, he sold way too early.
Colossally early, in hindsight. That stake, if he'd held it, could have been worth something like $19 billion by 2021. Just astronomical growth he missed out on.
What does that huge miss tell us about his sister's potential blind spots?
Well, it really highlights that his system seems geared towards near to medium-term catalysts. He's looking for specific events, a sale, a spin-off, a board shakeup to unlock value within a certain time frame.
Not necessarily holding for long-term compounding.
Less so, it seems. Once the initial fix is perceived as done, or the big catalyst doesn't happen, the drive to hold might lessen. He's an activist. He wants to be actively changing things.
And maybe a struggle valuing companies driven by intangibles and future growth.
That seems key here. As Netflix's value became increasingly tied to subscriber growth, content, brand things, harder to pin down with his traditional asset-focused toolkit, the soaring valuation probably got outside his comfort zone. It wasn't about breakup value anymore.
Discomfort with pure story stocks.
Could be. Once the value is mostly narrative and future potential, far detached from tangible assets, it doesn't fit his filters as well. Plus, that activist mindset. Job done. Company isn't broken anymore. Time to find the next target where I can actively intervene.
So that raider DNA, focused on realizing value relatively quickly, might ironically cause him to miss out on the truly massive long-term winners.
Netflix is almost the perfect example. Shows the system's power in spotting value and forcing initial change, but also its potential limitations when a company morphs into something based on growth and intangibles that defy traditional valuation.
Okay, no system is bulletproof. Let's put on our red team hats now. Where does the Icahn model break down? What are the conditions in today's economy where his strategy might really struggle or even fail?
Good question. The world has definitely changed since he perfected this playbook.
Market regimes seem like a big one. What about the shift towards intangible assets, network effects?
Huge challenge. His focus on tangible stuff, NAV, breakup value, just doesn't map well onto tech giants, driven by IP, data, network effects, brand. How do you calculate the breakup value of Facebook's network? His toolkit might just miss the point or mill-price these companies entirely.
And passive investing, all those index funds?
They can be a double-edged sword. Sometimes they vote with activists on broad governance issues, but they generally prioritize tracking the index over deep dives into specific company strategy. That can dilute the voting power needed for Icahn's more aggressive specific demands.
What about meme stocks? Retail investor armies?
Total chaos for his model. Markets driven by Reddit threads and sentiment are the polar opposite of his analytical, value-based approach. His carefully laid plans could get completely derailed by that kind of unpredictable volatility.
And we had that long stretch of super low interest rates.
Right. That inflated asset prices everywhere, making his deeply undervalued targets harder to find. Plus, cheap debt allowed weaker companies to paper over problems longer, delaying the kind of distress that often creates opportunities for him. He even pointed out Fed distortions back in 2014.
Okay, so market shifts. What about technological changes? Fast obsolescence?
Yeah, his campaigns take time, sometimes years. In industries like tech, the core product could be yesterday's news before he even gets changes implemented. The goalposts move too fast.
Those founder-controlled tech giants.
Massive roadblock. Dual-class shares giving founders extra votes, powerful figures like Musk or Zuckerberg. They're often immune to traditional activist pressure like board seats or forcing strategy shifts. His shareholder democracy playbook just doesn't work as well there.
Even AI and algorithms.
It's an arms race. AI can help activists find targets, sure, but companies use it defensively too. And the sheer speed of algorithmic trading might just outpace the timeline of a traditional deliberate activist campaign.
So, lots of external pressures. But are there inherent weaknesses, internal brittleness, in the model itself? Like the constant criticism about short-termism?
That's probably the oldest and deepest critique, is the focus on quick wins, buybacks, dividends, asset sales, sacrificing long-term health like R&D or innovation.
TWA always comes up here.
It's the classic example. Critics say he stripped assets, loaded it with debt, got his payout, and left it crippled, leading to bankruptcy. It highlights the potential for, well, collateral damage.
And the risk of just misjudging a complex business.
Absolutely. An activist focused on financials might miss the strategic nuances, pushing Netflix to sell early, or the big loss on Blockbuster because he didn't fully grasp the shift away from DVDs. These are cited as cases where the activist lens maybe didn't see the whole picture.
Reputational damage seems like a growing factor too, both for the target and maybe for him now.
For sure, aggressive campaigns hurt morale, brand image. And recent controversies around Icahn himself, that Hindenburg report on IEP structure, the SEC settlement over undisclosed loans backed by IEP stock, they can tarnish his own image.
Does that weaken his hand? The Icahn lift.
Potentially. If his own operations are questioned, it might weaken his leverage, reduce that immediate market reaction, and maybe undermine the moral high ground he often tries to claim in these fights.
And lastly, what about situations with just no easy fix?
His system shines with clear surgical actions. Sell this, fire him, buy back stock. It struggles more with deep secular industry decline or complex turnarounds that need more than just financial engineering or a new CEO.
So bottom line, incredibly powerful in its niche, but not universally applicable, and facing real headwinds from the modern economy. Assumptions about tangible assets and management vulnerability are being tested.
Yeah, the definitions of value and governance are evolving. His 20th century system needs to adapt to 21st century challenges.
Let's really put it to the test. A simulation. How would Carl Icahn, applying his OS, look at Tesla today? Seems like a nightmare target for him in many ways.
Oh, it's fascinating to think about. A perfect storm of challenges. Let's run the filters.
Filter 1. Significant undervaluation based on assets.
Almost impossible. Tesla's value is all about future growth, software, AI, brand, Musk himself. Not tangible assets like factories in the traditional sense. He'd struggle massively to find any NAV cushion. He'd almost certainly call it a massive bubble.
Okay, probably fails filter 1. Filter 2. Poor management or flawed strategy.
Now here he'd find plenty of ammunition. Governance, Musk's dominance, the board independence questions, the controversial tweets, that pay package getting thrown out by a court, classic Icahn red flags. He'd hammer the rubber stamp board idea.
And strategy.
Sales slowdown, China competition, uncertain timelines for Optimus and FSD, Musk's split focus. He'd have a field day criticizing operations and strategy. So filter 2 is likely a strong yeah.
Okay. Filter 3. Identifiable activist levers. This feels like the biggest hurdle. Musk's stake, the retail army.
It's incredibly tough. A proxy fight for control. Forget it. But Icahn wouldn't be totally without tools. He'd use scathing public letters, hit the media circuit hard, try to pressure any independent directors behind the scenes, rally institutional investors who might quietly agree on governance issues.
So levers exist, but they're weaker than usual.
Much weaker. Less direct control potential. More about public pressure and maybe influencing the margins.
Filter 4. Pathway to unlock value. What would he even propose for Tesla?
Governance reform would be huge. Demand an independent chair, separate CEO chair roles, clear succession plan, maybe limits on Musk's tweeting or time commitments. Asset spinoffs would be likely to push to spin out superchargers, energy storage, maybe FSD as a separate software play. That fits his playbook.
And capital discipline.
Absolutely. Question the moonshot R&D spending, demand bigger buybacks, even though he famously struggled to get Apple to do more buybacks years ago.
So if he did take a shot today, what's the likely playbook look like?
Probably take a smaller toehold stake. Just enough to make noise. Then unleash a public relations blitz, savage critiques of Musk and the board, demand those governance changes, spin-offs, capital returns, try to herd the institutional cats behind the scenes.
And a likely outcome. Fireworks.
Guaranteed fireworks. Musk hits back hard on X. Retail investors rally around Elon. Institutions caught in the middle. Could he force major change? Highly unlikely given Musk's power base.
So maybe a small win at best. Profit if the campaign hits during a correction, or forces minor concessions.
That seems more plausible. Maybe a symbolic board change, a small buyback pledge to get him off their backs. Think about his fight with Michael Dell. He extracted a higher price, but didn't stop Dell from taking the company private. Similar dynamic, maybe.
So Tesla really crystallizes the challenge. High valuation on intangibles, dominant founder, retail following, tech disruption. It pushes back hard against his core system.
Exactly. The governance critique still resonates, but the traditional Icahn OS struggles for traction against a 21st century tech phenomenon like Tesla. The cost-benefit might just not pencil out for him anymore in cases like this.
Okay, so we've dissected the system, stressed it, red-teamed it. After all that, what's the core distillation? If you had to boil down Carl Icahn's complex legacy from these sources into one key lesson for an investor listening today, what would it be?
Well, synthesizing it all. His OS is clearly powerful. Coherent worldview, disciplined filters, intellectual backing, the right temperament for it, hugely successful in its domain asset-heavy complacent companies.
But not perfect. We saw the limits with intangible tech like Netflix, founder power like Tesla, the changing market dynamics, the reputational risks, the TWA example.
Powerful but not infallible or universally adaptable. It's a system forged in one era, facing the tests of another.
So the one lesson, the big takeaway.
I think it's the profound and often really untapped potential for alpha generation that comes from proactive shareholder engagement focused specifically on fixing clear governance problems.
Okay, unpack that a bit. It's not just about picking stocks. It's about acting like an owner.
Exactly. What Icahn's career screams when you look at this material is that finding companies where management and owners are clearly misaligned, bad capital allocation, inertia, crazy pay, and then systematically pushing for actual fixes is a powerful way to unlock value the market is ignoring.
And crucially, this doesn't mean everyone needs to become a corporate raider.
Absolutely not. That's his specific high-stakes method. The principle is the transferable part. It's about embracing your role as an owner, not just a passive bystander holding a stock certificate.
Understanding that governance isn't just boardroom jargon, it directly impacts results.
Right. Because it addresses that root cause, the agency problem he exploited. Holding boards accountable, asking tough questions, demanding transparency and alignment.
You can actively participate in creating value, not just hope it happens.
Precisely. That principle of engaged, vigilant ownership thinking, beyond just the buy button, that feels like the most enduring and valuable lesson you can take from the Icahn playbook today.
It's certainly been a deep dive into a complex character and a powerful force in finance. Icahn's operating system, built on conviction, definitely leaves a mark, even as it faces these new challenges.
It really makes you think about how timeless principles intersect with changing times, doesn't it? Where do strategies endure and where do they need to evolve?
And that core idea of engaged ownership definitely sticks. So the final thought to leave you with from this deep dive: how can you, even in your own investing, start applying that principle? What does being an engaged, vigilant owner look like on your scale?
A question worth pondering.
Indeed. Join us next time on The Deep Dive for another exploration.